Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, I'm your host, Dr. Allen. Are you doing well enough financially but still concerned about what might happen to you and your family if you lost your source of income for even just a few months? If so, you share a commonality with the majority of Americans. In today's conversation, we talk with a contemplative expert who developed a plan with a solution to the problem that anyone can implement. As busy professionals passionate about the work of your calling, you may have come to realize that the hope of developing financial independence has taken a back seat to the priorities of following your passion. If you, like me, can identify with this, I have great news. Steed Tucker Capital is an investment company designed for professionals like you to help you develop financial independence built on solid passive real estate investments. Go to our website, steedtucker.com, and get your concise one-page guide to the 10 proven steps to profitable passive real estate investing. Today we talk with David Kamara, a returning guest from our Creekside Chats podcast, who is, in my estimate, a true Renaissance man. If life circumstances had not intervened, he would likely have ended up as a physician. Life took him in a very different direction, and he ended up with an MBA and a master's in liberal arts, both from the University of Chicago. He served at the executive level in Fortune 500 companies and developed a stock portfolio of over $1 million, cashed it out, and invested all of it in real estate. He began his real estate investing in single-family rentals and eventually moved his portfolio into multifamily. David, before we delve into real estate investing, you have an unusual origin story that our viewers and listeners will find of interest. So please just briefly take us back to where it all began.
Thank you, Alan. So my story is, frankly, not probably too different from many immigrants that came to the United States as students, as foreign students to university. I would say we had a bit of a detour because we had a civil war in West Africa where I grew up. Quick background, my mother is Ukrainian. My dad is from Sierra Leone in West Africa. I came to the United States to study and ended up studying computer science. I worked in Chicago for a number of years, ended up being a management consultant, worked for a few big professional services organizations and helped many Fortune 500 companies with a lot of different things. And while doing that, started investing in real estate and eventually ended up being a full-time real estate investor.
You skipped over one very interesting thing. As a teenager, your father was a physician and you apprenticed under him. And as a teenager, you actually did an appendectomy. Is that not correct?
That's correct. My dad is a surgeon in Sierra Leone. There's not a lot of physicians or per capita, per population. I did apprentice in my dad's clinic. I wanted to become a doctor, grew up wanting to be a doctor. When I was 17, I did perform an appendectomy with my dad assisting. Clearly, that's not something that would happen in the States, but it was very good. It was very inspirational. My dad made sure I didn't do anything too risky beyond his supervision. But again, it was a great experience. When I came to the States, though, I found out that it was much more expensive and difficult for a foreign student to become a medical doctor without the financial backing. Essentially, it was impossible to get a loan as a foreign student. So I ended up doing computer science and ended up in tech and IT.
Quite a detour with some very different circumstances. Not all of us have had to face a civil war and deal with refugee status. But the refugee status actually started in Africa, and I forget which country it was, adjacent to Sierra Leone, where you all
in Guinea.
In Guinea, yeah.
Everybody left Sierra Leone and the embassy shut down. We couldn't travel from Sierra Leone directly, so we went to Guinea, Conakry, which is French speaking, and then from there made my way over to the United States. And the original plan was to be in Germany, but that didn't quite pan out for various reasons, which we covered on your previous podcast.
Yes, we did. A very interesting life. You said your story was not that unusual from other immigrants, but yet it's a pretty unusual story. Anyway, we're glad you're here, and you have certainly made the best of some difficult circumstances. Well, let's turn to real estate, David. And why is it that so many people who are, by most reasonable standards, doing quite well, still terrified about the prospects of their financial future?
I think the setup of the U.S. economy, and frankly, most global economies, are such that workers continue working. Fundamentally, I think that's how it's set up, and many people don't necessarily stop to think about, do I just plug into this system, or do I do something innovative or slightly different to maybe set myself up in a different manner for my future and my family's future? I was there too. I was a very highly paid, highly educated individual, and it's very easy to get swept up in the excitement and the career progression and getting the next bonus or getting the next salary increase, the next title. A lot of people love their work. And so if you are doing what you enjoy doing, whatever field that is, and if you're getting compensated well, right, by any standards globally, people in the United States are compensated very well, it's easy to just continue doing it. I think the difficulty becomes the way that industries have changed, and there's not a lot of loyalty necessarily to the workers. There's not necessarily any need for a company to keep people longer than they're useful. Netflix actually put out a very interesting presentation it was something about the HR philosophy, but it was something like the thing that stuck with me was, we are not a family. We are more like a high contact professional sport. What that means is, once their use to the company diminishes, they get traded, just like professional players. So that shelf life, so to speak, is fairly short. I don't think many people think about their careers that way. We go to work, we make relationships, we dedicate our lives and many hours to a particular business, company, often with a mission that we believe in. And then we sometimes have this rude awakening of, oh, they don't need me anymore. Or even if they do need me, am I fulfilling my obligations to my family to the extent that I would like to? That was my personal dilemma.
Yeah, I don't think you're certainly not alone in that boat. That's certainly where I found myself, and very fulfilled in my profession in higher education. And like you said, it was very mission driven, and I felt there was a purpose and a much higher calling for what I was doing. And I just let my own financial well-being really fall by the wayside. And you're right. You have a place there as long as they see a particular value. But if that slips just even a tiny bit, they don't mind pulling the cord. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolio selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
You have developed a formula that has helped many couples attain their financial goals 7, 8, 10, and even more years before they had even initially planned. So tell us a little bit about the plan. There's the 3 components you have to that: make more money than you spend, invest savings wisely, and while you're doing that, to generate passive income. So you tell us, just give us an overview of the plan.
Sure. I developed what I call the personal cash flow formula. So many people go to business school or study finance, understand the financial statements, income statement, which is the P&L, profit and loss, the cash flow statement, which really says, are you net negative or net positive monthly, annually on how much cash you're getting in on the balance sheet, which is like your net worth. I think people understand this concept for companies, but I don't think a lot of people internalize that to themselves. And so think of the personal cash flow status or state. And that's what I tried to highlight in this. And again, this came through years of searching personally for something that would work for my family and I, so my wife and I and our kids. As I mentioned earlier, I was a very highly paid professional working for this, what seemed to be the machine in a way, right? Where you do good work, it's very intellectually stimulating and challenging. You're traveling to different places, sometimes overseas. You're participating in things that end up in the news, and you matter. You make a difference in the lives of many people, but then you're always very busy and sometimes not available to your personal family. And so the conundrum for me became, okay, this is great, this is working, we're making good money, and we were in a place where we're starting to save some money. I ended up leaving the corporate and started my own job, and I was still doing the same travel. So even though I was working for myself, I found that I really wasn't free from a time perspective. I wasn't necessarily able to be there for all of my kids' events. A lot of busy professionals grapple with that. There's a lot of focus on working mothers and how they grapple with that, but there's an equal focus, or should be, on fathers. Men fundamentally define themselves a lot by their career and what they do. The first question tends to be, what do you do when you meet in a social circle? But I think in a way, one thing that was missing, at least for me, was the amount of quality time that I wanted to spend with my kids. We have 4 daughters, my wife, and I felt like while I could provide well financially, I wasn't necessarily there personally and emotionally as much as I needed to be. So the quick 3 steps for the personal cash flow formula, which again, that evolved over time, was, okay, you definitely need to make money. You need to create some wealth and try to reinvest that wealth over time in a manner that doesn't require you to be there. And it's difficult because you have to start somewhere. You have to start probably in some kind of a W-2 job. And you don't have to leave that if that's something you enjoy. And many people have gone to school for many years to become specialists in their field. However, I think what is being widely marketed, if I could say that, is the Wall Street approach to investing, which is stocks and bonds and mutual funds and all these financial instruments. And what is not necessarily talked about enough is real estate. Andrew Carnegie said that 90% of the world's billionaires made their wealth through real estate. Again, this was many years removed, but he's not too far off. I think when I was doing this research, about 30% of people that are billionaires made their wealth through real estate. And it was like the second thing on the list behind, I want to say, technology and financial services. So it's a very proven path. And so I started looking at that. But the cash flow formula really talks about, take a step back from your perspective, be honest with yourself, try to understand where you are today. What is your cash inflow? What is your cash outflows? Meaning, what do you make as a family? What do you spend as a family? The key things typically are on the spending side are, of course, your living expenses, where do you live, house or mortgage or whatever that situation is, rent, transportation, food, health insurance, and then any kind of discretionary stuff and any other liabilities you may have or obligations you may have. On the income side is typically your job. For most of us, we work and maybe our spouses work. If you are spending more than you make, that's a tough hole to dig yourself out of. So over time, you have to develop that balance and make sure if you make more, you don't spend all of it, because at the end of the day, you want to invest that money to work for you. So when you're not working, the money is working for you. So you don't want to keep trading your hours for dollars. You want to put some of those dollars away and have them keep working for you when you're sleeping, which is what you can do with real estate. So that's the general gist of what the cash flow formula talks about. And it really doesn't necessarily try to steer people to any one particular form of investment. I have found that I studied the investment types and the investment vehicles out there, including cryptocurrency, which is the latest big thing. So what I found is that I studied the different investment vehicles out there for people that are available to folks like myself. And I found that essentially there are many paths, but I like the real estate path because it was fairly simple to understand. It was not a complicated business model, and it was a tangible asset. Moreover, when I studied the returns and the risks, real estate, and specifically multifamily real estate, provides an extremely good risk-adjusted return after taxes. And if you consider how again, how the asset is treated for tax purposes in the United States specifically. So for that reason, I like the real estate passive income approach, specifically in multifamily real estate. But again, people should study what is available and invest in what they're comfortable with, right? The number one thing is you need to know your comfort level, your risk tolerance. And I was saying one thing that I see a lot today is people talk about cryptocurrency investing and how much money they're making. And that's great. I think if you are making 100%, 200%, 300% in cryptocurrency, you should do that. I think the flip side of that is you should also understand that it's extremely volatile, right? And you could make 300% in 2 days and you could lose 150% the next day or 400% the next month. It's new. I definitely don't tell anyone not to invest in that. Just invest in it, eyes wide open, and know what your risk tolerance is. However, for me personally, I think if anyone is looking for something predictable, where they don't need the emotional roller coaster of investing, real estate, again, offers just a very great risk-adjusted return, meaning a great return with not a lot of risk, not a lot of volatility.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. There was one thing I think you didn't mention in terms of the reason you left the stock market and turned to real estate. It is risk adjusted, to be certain. And maybe you did mention this, the tax advantages to real estate. Talk a little bit more about those and why it is that there is such a great tax advantage with real estate.
Sure. That is a very important point. And I think not a lot of people think about that. Not a lot of people are educated enough to know this, but when people talk about returns, typically you talk about, okay, I just made 100% of my money in GameStop stock, for example. That's great, but you made that money most likely in a short-term capital gain setup, which means you held that stock for less than a year, which means I think at today's rates, you're getting taxed at 35% of whatever that gain is. So let's say you invested $100, you made $100, that's 100% of your money. Really, the only thing that you can spend is $65 because that $35 goes to a tax, capital gains tax. Further, there's an income tax on top of that you have to pay, right? So once you add those taxes up, you're maybe on 100% return on paper, maybe you're making 50%. If you're lucky. Now, not too many people were savvy enough or lucky enough to be in GameStop at the beginning of the year. So most stock returns on average are on the order of 8 to 10% over the past 20 or so years. And so if you make 10%, sure, that's a great return compounded. But again, depending on if you're planning to use that money, you will be paying either short-term capital gains tax or long-term capital gains tax, and then income tax on top of that. So I was in the stock market, did really well, but looked at that setup and said, that's not as great as it sounds. And again, I was very actively looking at these investments. On the real estate side, just because of the legal system and how the laws are written in the United States, you get this benefit of depreciation, which is really just a paper loss, right? The general gist of it is your property fully depreciates in X amount of time. For a personal residence, I think it's 39 and a half years. For a multifamily property, it's 27 and a half years. So in theory, if you bought something for $2.75 million in 27 years, that property is on paper worth nothing, with a straight line depreciation of 1% a year in 27, or whatever the math works out to be. So when we buy properties, when we invest in properties, there's actually something called accelerated depreciation, which you can take, which again, this is all very legal. This is not a scam or anything. But if you think about the structure of your buildings, not everything depreciates at the same rate. Your appliances depreciate faster, your sidewalks, your HVAC systems, all of those things don't live for 27 and a half years. And you can get an consultant to come to your building and analyze all this. And the things that depreciate sooner, you can take those losses, quote unquote, on paper sooner, which what that ultimately leads to is when you generate cash flow from the real estate investment, you distribute that cash flow. In our case, we distribute that cash flow to our investors. We then give them a K-1 investment form at the end of the year for taxes or in March. And that shows a paper loss because of the depreciation, which means even though they received a cash distribution, on paper they lost money that year, which means it cannot be taxed by default. If you didn't make any gains, you can't be taxed on them. That's going into the nitty-gritty of it, but everybody should definitely seek advice from their tax accountant and see how that applies to them. But a lot of our investors certainly are coming from high tax states such as California and other places where they're looking for some tax shelter. And just in the United States, real estate is just extremely tax advantaged. The government encourages you to own private property, to own apartment buildings, to provide those kinds of living services to the population because the government can't do it all by itself.
Yeah, I think I've heard the expression, if you're investing in the stock market, don't fight the S&P 500. And if you're investing in real estate, don't fight the IRS. And you should do fine. Not only is there a tax advantage to investing in real estate, that stock investing just doesn't come with it. There is also the aspect of appreciation. So if you are getting on your property, say for instance, in your stocks, you're generating 8 to 10%, which is pretty good return on, and it really is the average really over the last 67 years in the stock market. And real estate is on a multifamily complex, 8% is generally considered a pretty basic return, the cash on cash return. But on top of that, you get an appreciation depending, of course, where you are and where your property is in the country. But that appreciation rate could be anywhere from, it's going to average probably at least 4%, and generally it's going to be more than that on multifamily. So talk to us about that aspect of appreciation and how that makes real estate also an advantage over stocks.
There's an acronym which is called IDEAL, IDEAL, that's used for real estate, which has essentially all of those advantages. In the I is income. You get the income, 8% cash on cash. That's a fairly average return, which again, I think what people should remember is most of your investments in real estate, you'll get paid that cash on cash return. And I think the point you're getting to is during the time that you own this asset, the building tends to appreciate if it's run properly. So you get the appreciation. I already covered the depreciation, which is the tax advantage to it. So the IDE is equity. So as you own that asset, you actually are paying the mortgage. And so you're building up equity, or your tenants are helping you build up equity. So there's that advantage, appreciation, and then leverage. So IDEAL is income, depreciation, equity, appreciation, and leverage, right? So if you think about stocks, you can't go buy stocks with, say, you can buy stocks on margin, but the most you can go is like 50% or so. With real estate, you're typically leveraging 20, or you're putting 20% down, you're leveraging 80% or 75%. You're leveraging significant amounts of debt to get into this asset, which further juices up your returns. Back to the appreciation stuff, which was the crux of your question. The great thing about real estate is that it is valued as a business, and it's essentially valued as a multiple of profit that the building generates. If you're over time doing the little things, which is you're improving the building, you're raising rents, you are making it a more attractive place to live, and there's more demand for it, which tends to be the case just based on the population dynamics and demographics that we face in this country and in the world as a whole. There's more demand and rents go up over time. And while your expenses will rise to meet those rents, they wouldn't rise at the same level if you're paying attention and operating the asset. So definitely when you go to sell, whether that's in 3 years, 5 years, 10 years, that building gets valued based on what is the cash and profit it generates, and based on that it appreciates quite a bit. Yes, so when you sell this asset, then with what we do with our investors is we share in the profits, right? And so while you've been getting that roughly 8% cash on cash every year, you then get a big chunk of money that comes back to you when we either refinance the asset or sell it, and whatever the holding period tends to be.
Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. Just given all of that, there really is truly an advantage to investing in real estate. What is it that keeps people from taking that step and investing in real estate as opposed to the stock market?
Yeah, I think the main thing probably is education. I've spoken to a few people and they actually remarked that they didn't know you could own apartment properties, right? There's not a lot of advertising there happening for, hey, let's go buy a building. With podcasting and just the returns recently, it's come more to the forefront. But of course, there's a lot more, I'd say, visibility around stock market, and some of the equity firms do a very good job of marketing. A lot of people know about real estate on the single family front. Most people either think of buying another house, which is accessible because many people own their personal residence, and then they think, let me buy a house and rent it out. And that makes sense, except there's a big inconvenience with dealing with tenants, right? And most people don't want that. So many of the people that I was speaking to that ended up investing with us, their very first comments were, they basically asked me if they could invest with me. I wasn't even trying to have people invest with me. Their point was, we have always wanted to be involved in real estate, but we don't know how to get involved without having to take calls about dealing with plugged toilets and things we don't want to deal with. So it's not, there's this kind of stigma with, I don't want to deal with tenants, which yes, can be a massive headache. Absolutely. So I think most people get turned off from real estate for that reason. And frankly, it's hard to manage single family houses because the economics aren't quite there for you to go get a professional property manager. It makes more sense to do once you're at a certain level of scale, once you have maybe 30, 40 units that you're managing, and they're hopefully in a close geographic space. Combined, all of those things have made not so many people invest in real estate. But again, with multifamily syndications, I think that has become a lot more doable for many people.
Yeah, I think that's right. People just don't know about it. Investing in a real estate syndication is not as easy and as passive as going to your financial advisor. It's just not that passive. But on the other hand, it's not that challenging and that difficult either if you just find a syndicator and they'll work with you and help you through that process. And it's really not as challenging and as time consuming as what a lot of people initially think.
If I may add, I think there's probably also an element of trust. If you're not going to do it yourself, you need a trustworthy partner. And I think with syndications, that's a big challenge. The stock equivalent of that would be to invest in a REIT, but then you really don't know what you own. And I would say maybe one more thing is just trying to understand what liquidity look like. So I would say that one of the reasons that people have second thoughts about investing in real estate is your investment is not as liquid, that's for sure. And that's one disadvantage from things like stocks or any other financial instruments that you can trade in and out of multiple times a day. If you're investing in a property, you're probably tied in for some period of time longer than what a stock investment could be.
Absolutely.
And some people don't like that.
Yeah, there is that aspect of liquidity, which real estate is not a liquid asset. What are the 5 steps to financial freedom?
I think you could parse that in many different ways, but from my perspective, and when I speak to people about the personal cash flow formula, the main thing that I tell people about is, from a personal cash flow standpoint, I think of financial freedom as not a particular number in my bank account. I think about it as a certain amount of cash flow monthly that covers my expenses and goes beyond that. That's where my evolution of this thinking has come to. Because if you think about it, we don't always know, for example, even if there is a certain number of money in the bank, we don't know how long we're going to live anymore. People are healthier, people are much more active, people are much more conscious about what they eat and how they comport themselves. You may run out of cash. You really may. And again, if you, however, have a certain amount of cash flow that comes from passive sources, whether that's frankly dividends from your stock account investing, whatever asset classes you invest in, whether you have a business or a franchise that you know that there's a certain amount of money you can rely on. That's it for me. I'm almost even beyond 5 steps at this point. That for me is the definition of being able to do what you want. Financial freedom for me is you don't have to be rich, right? There are many people that are, quote, financially free that don't make a ton of money. They just have enough to cover their monthly expenses. If your monthly expense is $10,000 and you make $12,000 from some passive means, what else is there? You can spend your time doing whatever you want. And that's the key.
Very good. David, before we go into our last segment, our viewers and listeners, how they can get in touch with you.
You can reach me at capesierracapital.com. While you're there, you can download the personal cash flow formula. It's capesierracapital.com/cash flow. I'm always happy to answer questions, chat with individuals about really any topics. That's the best way to get a hold of me.
We'll have this information in the show notes. David, share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that?
I think I would have to talk about the civil war in Sierra Leone. There was a period when I was already in the United States when we had a civil war in Sierra Leone, which was not along ethnic lines or religious lines. It was really just people trying to take advantage of the local resources of the country. I was in the United States. I was 19 years old. They blew out the telecom exchange for Sierra Leone. This is before any internet communications. The only way you could really connect with your loved ones is to call them. And they blew out the local telecom exchange. So there was no telecom communications at all. My parents and my sister were in Sierra Leone at the time, and I couldn't reach them. I just frankly had no idea of whether they were alive or whether I could speak to them ever. It was a very difficult time emotionally and mentally because I was here by myself. And while I had some friends from Sierra Leone here who helped me, it was just one of those cases where you don't really know what life will be like and when you will be speaking to your loved ones. And it's not like you can get on a plane and go there because there's a war. So it was a period of reflection, prayer, hope, and eventually I received a call saying that they were fine and things were okay. Relatively speaking, they were alive and nothing truly horrible had happened, and very tough. I was able to get my mom and sister to come and stay with me in the States. My dad couldn't get a visa at the time because, again, Sierra Leone was under this civil war setup, and my mom and sister had a Ukrainian. I actually contacted the local congressman in Michigan to see if he could intervene on my dad's behalf. But my dad then just said, I'll stay here. My dad's a doctor. I'll stay here. It's fine. As long as your mother and your sister are out of this mess, I'll figure out what's going on here and I'll help people because it's a war setup. Doctors are needed. So then my mom and sister landed in the States, and I was going to community college at the time, working a full-time job, trying to support them, myself, and go to college at the same time. It was a great experience in that I knew they were safe and I felt I was providing for them. But that really helped with my personal fortitude and self-reliance and trying to be independent and really trying to set myself up for being able to help my family should something like that ever happen again. And it's for us, it ended up ending in a fortunate manner where nobody really suffered too much. My dad was fine and my mom and sister went back eventually. But it was a very difficult time, especially being that young and having a lot of responsibility, not just for myself, but also now for my mom and sister.
That was a tough time for sure. And at such a young age to take on all of that responsibility. That must have set you up for big responsibilities that came later. Those times have passed and you're in a very different place these days. So tell us, how are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
I am still a huge supporter of any kind of development in Sierra Leone. My dad is still in Sierra Leone. Together with my sister, we raised money to build a hospital back there. And my dad sees patients in this rural area, about 20,000 people, where otherwise there wouldn't be a hospital or a doctor. So I'm very proud of that. Some friends of mine from Sierra Leone started a nonprofit called EYES, which is focused on educational opportunities for youth. So it's educational youth opportunities. And what we do is, through their organization, is we sponsor students and just pay for their school fees. Because again, as little as that is, fees are relatively expensive. People living in Sierra Leone, and often that's a difference between whether parents will choose to send kids to school and we've been doing that for a while. And I'm very proud to say that some of the students we've seen graduate through high school and actually enter colleges in Sierra Leone. And that has been very good. With my wife, we've supported things like Unite for Sight, which is a global nonprofit that helps with both education about eyesight, but also eye care. And then also things like with the recent Ebola outbreak in West Africa, we raised money to send PPE to people back there. PPE is personal protective equipment, not too dissimilar from what was happening with the COVID challenge here. So those things, but also just trying to educate people about how they can get more of their time back, trying to talk to busy professionals that are in the same place I was before and tell them about think through your personal situation and start putting money into places where you can generate passive income. We just recently closed on a 124 unit property in Michigan. It was a great deal. Again, one other thing I think on the real estate front that we didn't talk about is today there's a lot of talk about inflation, right? Especially with all the money being printed and injected into the economy to overcome the current COVID situation. One thing that real estate is great at is it's a great hedge to inflation, right? So and it's really very simple. Prices are going to go up. There's more money in the economy. Over time, that will find its way into all parts of the economy, including rents. And for any real estate investment, you're mostly getting debt that's fixed for a period of time. So as time goes on, that gap between your fixed rate debt and the inflation on rents buffers your investment and ends up being a very good investment from that perspective. So that's one of the things that I try to talk to people about and just let them know that this is something they shouldn't be overlooking.
Some very good outreach endeavors that you're involved with there. David, imagine that you have come to the end of your life, and as you lay on your deathbed, what do you look back on your life as your greatest joys and your greatest sense of fulfillment?
Yeah, it will have to be my family. I'm extremely grateful for my wife is super supportive of me in this and any other endeavors we pursue together. I work with her on the real estate aspect. We do deals together. Our kids, I'm extremely happy and grateful that they are all healthy and mentally healthy and physically healthy. And I think that's one thing that you sometimes don't control as parents. There's a lot of people that just find themselves in different circumstances. Just seeing my kids do well in sports, school, friendships, just be as they grow up, you see little pieces of yourself in your kids, and it's an extreme joy, right? Just to see that, oh, they're so different, but yet they have these little pieces of myself and my wife in them. I'm very grateful that my parents are both still alive and in good health. As the years go by, I have a lot of friends that are not so fortunate, and I don't take that for granted. And so I think one of the things I'm very happy that I can do is spend more time with my parents during these times and during good times as well, and try to travel with them, go to places while they're still active and do things with them. Being an entrepreneur back in Sierra Leone, I think very early as a kid, I sold drinks at my dad's clinic. I sold cigarettes at the hotel my mom used to work, and it was just interesting, fun, challenging. Didn't really think much of it, and I can continue doing those things with real estate and my IT consulting business, which is becoming less of a focus, frankly. But it's been very, I guess, fulfilling to be able to be an entrepreneur and do well and do good at the same time.
David, once again, it has been a pleasure being with you. Enjoyed the conversation. Thanks for being on the show today.
Thank you so much.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.